This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Trade tensions. The White House could announce steep tariffs tomorrow, but they may not apply to every country.
Ready to retaliate, the European Union will fight back if tariffs are enacted, and that could ripple through the American economy and the global markets.
South of the border, why car imports from Mexico are not slowing down. Those stories and more tonight on Nightly Business Report for Wednesday, March 7th.
Good evening, everyone, and welcome. As a heavy snow fell on Wall Street, trade concerns clouded the stock market. There are reports tonight that the president will make official his plans to levy tariffs on steel and aluminum imports as early as tomorrow, though the White House says there could be exemptions.
We expect that the president will sign something by the end of the week, and there are potential carve-outs for Mexico and Canada based on national security and possibly other countries as well based on that process.
And those words alleviated some concerns about an all-out trade war, which Wall Street does not want to see, and stocks finished the day off their lows. The Dow Industrial Average did, however, fall 82 points to 24,801. It had been down about 300 points, maybe more, midday. The Nasdaq ended with a gain of about 24, almost 25, and the S&P 500 essentially flat, down 1 1/3. But investors won't know all of the details of the tariffs until they are announced, and it's a real concern for investors. Bob Pisani explains.
It was another tough day for traders. Stocks meandered for most of the day over a number of big issues that traders are having a hard time figuring out. Who's going to replace Gary Cohn? How does China play out? How does NAFTA play out? This is not something your average portfolio manager has an edge figuring out. Traders want to focus on earnings and global growth, two factors they can quantify. But in this environment, you suddenly have to become a trade expert. The most important people now are trade policy wonks. Nobody's talked to them for ages, so it's hard figuring out things. The tariff story is a big problem for the stock market because it upsets the main narrative that the global economy is expanding and that earnings are at record highs. A trade war will reduce growth and it will endanger that whole growth story. So with so much event risk, trading is light. Stocks are meandering around in a fairly narrow range. The S&P really did not break out until later in the day when White House Press Secretary Sarah Sanders said that Canada and Mexico might be exempt from tariffs. The president is expected to make a formal announcement as soon as tomorrow, possibly at noon. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
As we mentioned, stocks fell sharply midday over concerns of a possible trade war, which were amplified by the departure of White House economic advisor Gary Cohn, which we told you about last night. He is seen as pro-free trade and business-friendly, and his resignation left investors with a lot of questions. Kayla Tausche reports from Washington tonight.
Gary Cohn's departure comes as a sharp disagreement with the president over tariffs on steel and aluminum emerged. The president suggested conflict is good.
I like conflict. I like having two people with different points of view.
But the division became untenable as Trump moved to make a spur-of-the-moment decision on tariffs, which Cohn had argued would drive up costs and anger allies. Commerce Secretary Wilbur Ross said today the president could still tweak the final decision.
He has a willingness to give an exemption to Canada and to Mexico, provided that we work things out in NAFTA.
Crunching tariff numbers, just one of the National Economic Council's jobs. While Gary Cohn was its public face, roughly a dozen high-level officials work behind the scenes. Their reach extends from crafting the administration's approach to major summits like the G7 and APEC, to writing the infrastructure proposal that has since stalled on Capitol Hill. With Cohn's exit, investors worry an exodus from the team he handpicked may follow. At an infrastructure event today, top Senate Democrat Chuck Schumer suggested the agenda has already suffered from turnover.
The White House is getting hollowed out, and the number of people capable of doing things, doing real things, whether you agree or disagree ideologically, is getting smaller and smaller.
The White House expects to formalize the tariffs before the end of the week as it searches for Cohn's replacement. Complicating the choice, some in the running, like Larry Kudlow or White House economist Kevin Hassett, also oppose tariffs. The job of NEC director does not require a Senate confirmation, so the president could act quickly. if he chooses. For Nightly Business Report, I'm Kayla Tausche in Washington.
European Union officials will also pay close attention to what the president officially decides on trade. And as Willem Marks reports from Brussels, the bloc, already bristling, is ready to respond.
The war of words over trade and tariffs continued on both sides of the Atlantic Wednesday, with the European Commissioner for Trade, Cecilia Malmström, outlining potential moves that the Europeans might make in response to potential proposals from the Trump White House. It was a three-pronged approach that she described, in which initially they would try and work with non-European allies to reverse any US government decision under the World Trade Organization rules. That was because, she said, they weren't buying the reason given by the Trump White House that essentially this was an issue of national security, given European relationships with the US when it comes to security itself. The second element of the approach would be to try and protect European steel producers from steel products that might be diverted from the US into Europe by trying to erect their own safeguard measures. And the third, targeting specific US products. There was a detailed list that was sent around to European heads of state and governments earlier this week. Malmström would not comment on the specific details of those products, but they do include food and drink, agricultural, as well as specific steel products. That totals around 2.8 billion euros. That's around $3.5 billion. And she said that was equivalent to the kind of economic damage she expected the Europeans to absorb from these steel and aluminum tariffs. None of this concrete yet, but she did say that any response the Europeans did make would be firm and proportionate, and indeed, unlike the US, she said, by the book. For Nightly Business Report, I'm Willem Marks in Brussels, Belgium.
The head of the Atlanta Fed says trade tariffs could hurt the U.S. economy if they are enacted and, in theory, dampen the need for interest rate hikes. Raphael Bostic said that levies could offset any economic momentum from fiscal stimulus, but he also added that it was important for the central bank to take a wait-and-see approach since there are no concrete details right now.
And ahead of the president's official announcement, a number of CEOs have come out both for and against potential tariffs. Here's some of what several of them had to say.
I don't like the concept of putting tariffs. If you want to do surgical actions, go ahead and do surgical actions. But doing broad tariffs like peanut butter is not good for any industry.
If you get into a trade war with retaliatory action and it goes into things like apparel, it could dampen the effect, it could hurt the momentum that we have right now, and people are very worried about it.
The levels of imports and the circumstances of imports are threatening not only our internal economy, but our national security.
The steel and aluminum tariffs, we're just wrapping up a $30 billion construction effort. So we don't think it's going to have a meaningful impact on our business. Just as an American, though, I would hate to see any type of a long-term trade war with any of our customers or counterparties.
Our trading relationship with Mexico and Canada is critical to U.S. competitiveness and U.S. jobs. It's so clearly in the interest of the United States to have strong trading relationships with both those countries. I'd be optimistic about how this actually gets implemented.
I kind of agree what the Trump administration is doing, and I think we would have chosen option number 2, which is targeted tariffs with some quotas, although we're not too keen on the quotas, but we would accept that.
We do have plans for expansions in the U.S. We heard about the tariffs, and we still are planning to proceed.
I'm suggesting that we stop playing tit for tat, that we get our blood pressure to go back down to normal, and we sit down at the table and find a way to resolve this issue. I don't think we have to escalate this into a full-blown trade war.
Well, let's turn now to our next guest for more on how potential tariffs and turmoil in Washington could impact the economy and markets. We have Michael Yoshikami. He is the founder and CEO of Destination Wealth Management, and Jason Ware is the chief economist and chief investment officer at Albion Financial. Gentlemen, welcome. Jason, let me start with you. What are you going to be watching for tomorrow with the president as he makes this announcement? And if indeed tariffs are imposed, how damaging do you think they will be either to the market or to the economy?
So that's the critical question, right? And what we're looking for tomorrow is just some more specifics around the plan. What we have so far is just this high level, painting with broad strokes type of description of what these tariffs might look like. So getting some details around that is important. But to address the second question, which I think is a more important question, is what's the potential impact on the economy? That really depends. Are we talking about Tariffs on steel and aluminum, full stop. That's the end of story. There's no additional goods that are going to be coming down the pike. There's no additional tariffs that are going to be added by the administration. We don't get any reactive policies from our trade partners. And indeed, we might have some carve-outs for Mexico and Canada. If that's the end of it, then the negative impact on the economy is probably rather limited. However, if this escalates and disputes become ugly, and we see that our global trading partners start to have reactions to these policies that are damaging to basically the fabric of global trade, and this is just one of many policies to come, then I think that's where the real economic fallout happens.
Michael, early today, the market was selling off, and the explanation from some was that it was in reaction to the departure of Gary Cohn, who is perceived to be one of the globalists within the White House, an anti-protectionist. It seems to me that it was more what he stands for than the man himself that was a concern here. How worried would you be as an investor if Gary Cohn's departure results in the person who takes over for him being a hardline protectionist hawk?
I'd be worried. I think that Gary Cohn was a moderating force. And I think, as you correctly state, more of a free trade, business-friendly appointment. I think it was widely applauded when he was appointed to the position. And if he moves out of that position, whoever replaces him is going to be the one that really is going to set the tone for how the administration is going to move forward in terms of trade policies. This may be just a warning shot. It might be just aluminum and steel, get everyone's attention, and now maybe that helps us at the negotiating table. Again, if it becomes more of a trend, this is just the first industry that's going to be impacted, that's problematic. I don't think anybody should really be surprised that we're seeing Gary Cohn leave. I mean, it was clear that he was very much against these policies, and I think it was inevitable that he would leave, and inevitable the market would shudder a bit when he did.
Mm-hmm. Jason, if indeed, let's assume that these trade tariffs are put in place, how soon do you, as an economist, expect to see some sort of impact, be it minimal or more than that, in economic growth?
So, that's, again, difficult to predict. I wish I had a real clean answer there for you. But I think these things typically filter through the economy with a bit of a lag. That said, the plans for expanding, if you're in the steel industry or aluminum industry, might be more immediate. I mean, we've already seen a number of CEOs come out and say, if these are enacted, we plan to expand or we plan to hire. But I think the backside of that and the more troubling side of that is what happens to the industries that use steel and aluminum as inputs. Mm-hmm. Their costs go up, and how are they going to respond to rising costs? And the reality is that there are far more people employed in those industries, and indeed export industries, than there are in steel and aluminum. So the ripple through the economy will take time, but on balance, it's likely to be a net negative given what I just described. So it's something that bears watching.
Michael, quick answer here. You put money, real money, to work every single day. Are you doing anything different today in light of all that's happened over the past 30, 35 days than you were in late January?
Well, we certainly, in terms of trade policy, we're looking at companies that are going to be impacted downstream by these types of behaviors. I think the impact on the economy is going to be, it's going to take time for that to filter through. The impact on psychology, both the market as well as CEOs that are looking at spending in terms of infrastructure spending in aluminum, steel, and whatever downstream industry might be. I think that impact is going to be real and immediate, and it's something we certainly factor into our strategies.
Michael, thank you very much for joining us. Jason, thank you as well. Gentlemen.
Thank you.
Thank you.
All right, it's time to take a look at some of today's upgrades and downgrades. Deutsche Bank says General Electric is one of the companies that could be hurt the most if the Trump administration's tariffs are enacted. The analyst maintains his sell rating on that stock. In response, GE says forget about it. The report, it says, is completely ungrounded. The company says the impact would be minimal. Shares of GE fell fractionally to $14.51. Netflix saw its rating cut to hold from buy at Stifel. The analyst says the stock price has risen too far too fast. Simple as that. However, the firm lifted its price target on the stock to $325. That's roughly where shares are right now. Shares of Netflix did fall 1% today to $321 and change.
At least 14 analysts raised their target price on Autodesk. One such firm was RBC, which pointed to the software company's better than expected quarterly results and also its subscription business. RBC put a $156 price target on that stock. Autodesk shares gained 14% to $137.70. Match Group's price target was hiked to $50 a share by Jefferies. The analyst says the stock, which has risen more than 150% over the past year, could go even higher. But he adds that stock is not cheap. Match Group shares were up 3% to $43.81.
And coming up, with all the talk of tariffs and NAFTA, U.S. automakers have a big stake in cars made south of the border. A look at how Mexican auto production is faring.
A new survey from the Federal Reserve describes inflation pressures as moderate. The Beige Book, which is an anecdotal look at the economy across the country, points to tightness in the labor market and an increase in wage growth. The central bank said the economy overall was growing at a modest to moderate pace. The report is expected to bolster the case for an interest rate increase when policymakers meet later this month.
The labor market remains robust. Private sector employers added 235,000 jobs in February, this according to the payroll processor ADP. That was more than economists expected. The gains led by leisure and hospitality and the retail sectors as consumer spending increased.
Well, the trade deficit increased to a more than 9-year high in January. The Commerce Department reports that the trade gap rose 5% to more than $56 billion. That was more than the expected shortfall with China, which widened sharply.
Well, while the U.S. threatens to slap a tariff on steel and aluminum imports, it is also threatening to rip up the North American Free Trade Agreement. And if NAFTA goes away or is radically altered, it would have a major impact, especially for automakers. Despite the threat of Mexican-made autos being slapped with a tariff, auto production south of the border is not slowing down. Phil LeBeau has more.
Mexico's auto production is surging, up more than 6% this year. That may come as a surprise given the heated rhetoric from President Trump, who has threatened to slap a border tax on cars and trucks built south of the border and sold in the U.S. Trump's biggest complaint, as Mexico's auto production has shot up to nearly 4 million vehicles a year, so have auto imports. Last year, GM exported more vehicles from Mexico than any other automaker, and it has no plans to shift production from Mexico to the U.S.
I believe that when you look at the complexity and the long lead business that we're in, those kinds of shifts, they just aren't economical.
The fact is, GM makes a huge profit in pickup trucks it imports from Mexico. But it's not just GM. Fiat Chrysler has also increased production south of the border, while Audi recently opened a plant there. And soon, Mercedes and BMW will do the same thing. All of this as negotiators from the U.S., Canada, and Mexico are struggling to find a way to rework NAFTA, a trade pact that even the automakers believe should be updated.
When you think about NAFTA 25 years ago and think about the technology that's in a car today, I think there's rules and things we can modernize with tracing, et cetera, that'll make less of an administrative burden but still accomplish what the administration and the three countries need.
Further complicating the NAFTA talks is the question of what happens if the Trump administration imposes a tariff on imported steel and aluminum. Does that mean that vehicles built in Mexico would be hit with a tax when they're shipped to the U.S.? If so, that could finally slow down the flow of vehicles built south of the border. Phil LeBeau, Nightly Business Report, Chicago.
ExxonMobil says earnings could double by 2025, and that's where we begin tonight's market focus. The oil giant told investors that if oil prices remain around the current $60 a barrel price, the company could see profits grow more than 100% by 2025. Exxon said key drivers of growth are expected to come from foreign and domestic exploration projects, as well as some plant expansions. The shares fell 2.5% to $74.26. Dollar Tree reported a rise in sales and profits during the holiday quarter, but the results didn't meet expectations. The discount retailer is also forecasting full-year profits below estimates. Dollar Tree shares were off more than 14% to $89.25. Abercrombie & Fitch is beginning to see its sales pick up. The clothing retailer reported same-store sales that rose for the first time in 5 years, as results benefited from fewer stores and stronger demand. The company has been closing stores and renovating others and improving its online systems. The shares rose nearly 12% today to $23.89.
Well, strong bourbon and whiskey sales helped results top expectations at Brown-Forman. The maker of Jack Daniels also reaffirmed its full-year outlook for sales growth, but the company is wary of being caught up in a trade dispute. A European official last week cited Kentucky bourbon as a possible target of retaliation if the president's steel and aluminum tariffs take effect. Brown-Forman shares fell more than 5% to $52.89. After the bell, the casino operator Caesars reported a quarterly profit that was helped by the new tax law. The company also saw sales rise across all of its divisions. Shares initially rose in extended hours and also finished the regular day up 1% at $12.50. Also out after the bell, Costco's rise in same-store sales that came in slightly below analysts' estimates. The wholesale retailer also delivered a profit miss, but overall revenue was better than expected. Shares initially higher in after hours, then they dipped just a bit. They ended the regular day down 2% at $187.36.
Coming up, the gender gap in the workplace and how to close it. Amazon is taking aim at Walmart. In a move to court lower-income shoppers, the online retailer is offering a new discount of more than 50% on its Prime membership to Medicaid recipients. The goal, according to the company, is to give more people access to the digital economy. Some also say that by targeting this demographic, Amazon can continue to grow in the U.S.
And ahead of the International Women's Day, 2 new surveys examined the gender gap in the workplace and how to close it. Julia Boorstin has our report.
The bad news, when it comes to women in the workplace, things are much worse than people think. But on the upside, there are plenty of solutions to help close the gaps. Misperception about the gender gap are massive, according to a new survey by the organizers of International Women's Day, conducted by Ipsos. People vastly underestimate how long it'll take to achieve equal pay between men and women, based on the current pace of change.
Understanding the misperceptions in the pay gap are important because right now Americans sort of feel like it's getting better and feel like it's going to be something that's going to disappear pretty much in their lifetime, in the next 10 years. The real answer is that the pay gap's not going to disappear until pretty much all of us aren't working anymore.
And it extends to corporate leadership as well. Survey responders believe nearly a fifth of the world's top 500 companies have female CEOs, while in reality, the actual figure is just 3%. So what'll it take to change that ratio? Another survey is out today from Accenture with recommendations on what policies companies can implement to help close the gap. Accenture finding companies that are transparent are likely to achieve workplace equality much faster. That means leaders should communicate about everything from the gender breakdown across their ranks to their specific goals around hiring and closing the gender gap. One surprise is that just improving maternity leave can actually hold women back in their careers, but encouraging men to also take parental leave actually improves women's advancement. And women are more likely to advance if they're involved with a women's network, which over 80% of respondents say their company does not have. An added benefit? Changes that help women, such as the flexibility to work from home, should benefit everyone. For Nightly Business Report, I'm Julia Boorstin in Los Angeles.
And that does it for us tonight. I'm Sue Herrera. Thanks for watching, and we want to remind you, this is the time of year your public television station seeks your support.
And I'm Tyler Matheson. We thank you for your support, and we will also see you tomorrow.